Hey, what's happening?
That's going live. We are live.
There it is.
Welcome everybody to another episode of Ask Me Anything. We were already laughing at ourselves, apparently.
We're having a good time without you, folks. So we're here to rock and roll. And Brian asked me not to say this. He said, "Don't say we're having a sausage fest." Well, while we're doing this, ask me anything. There's a bunch of dudes.
Yeah, don't say it. Don't say it.
I won't say it, Brian. I won't say it.
All right. With that, everybody, get those questions into the chat box. We want to see a lot of questions inside there. So we'll be back in about 14 seconds, and we'll do a little bit of a round the robin. All right, welcome back, everybody. Once again, get those questions into the comment box, and we're going to go ahead and go around the horn here and do a quick introduction. So a lot of you know that I'm from northern Idaho, and it's been kind of a weird winter. We're not having a lot of snow, none of that kind of stuff. Actually, it was really warm. I actually drove my Cougar for the first time. I think it was yesterday or day before. I drove my Cougar, my classic car, and right now it is actually dumping. It is snowing really hard right now, and the power's already gone out once. So never know what's going to happen with the weather right now, apparently. Kind of like the economy. But with that, I'll go over to Joe.
I'm Joe. They call me HELOC Joe. I'm up in New York, in Buffalo, about an hour away from Kevin, 20 minutes away from Chris, so near the team. I've been doing HELOC since 2009, private money lending since 2013, infinite banking since 2019. Here to answer all your questions. Bring them in. Next to Jason.
Thank you, Joe. Thank you, Brian. Brian, I don't know if the end's, riding the Cougar. I don't know if that's something we want to say on here either. So, but I'm here in, the city, beautiful Orlando.
He's out of hand.
It's hot out. That's why I came on with sunglasses. I was out getting some steps in, getting warmed up for this, and all ready for your questions today. I'm warmed up, so let's go. Let's over to this man over here, Kevin Krause, Mr. Captain America.
Hey, what's up, guys? Kevin Krause, upstate New York. Like Joe said, not that far, a few hours from the team. I actually got another person I want to introduce here real fast since he wants to say hi. Oh, maybe not. All right. My little guy, he was kind of wondering if he could just get on here real fast. And I said, all right, no problem. So, yeah, obviously we were talking about whole life and becoming your own banker. If you're a beginner, obviously come out, grab your book. Take a read, watch lots of YouTube videos just like I did and the rest of the team does. Lots of webinars every single week that we put out, Chris and the team puts out, which is awesome. As far as the Captain America shield, that's definitely one of the prime things. Number one, being a military soldier back in the past. Red, white, and blue America. And then obviously it's strong. It's a legacy play, right? It's something that you can pass on to the next generation. It's strong. It can withhold, different types of blasts from all different types of superheroes. And then, so this thing's kind of like my policy. And then Joe HELOC, this is kind of funny, but this kind of reminds me, Joe, right? This is the blaster, right? To blast that debt, right?
There you go.
See the thing in the back is the policy. So just lots of different ways you can relate, what we do to, superheroes, to fun, to overall just regular things in real life that everybody knows, likes, and understands. So with that, do you want to say hi or no?
Hi.
All right, this is Cam. All right, and he's turning 10 here in July. So
nice.
What do you say?
Nice.
All right.
Awesome. Hey, so we'll kind of get rolling. So once again, everybody, go ahead and get those questions in there. If you don't have any questions, it's going to be a very interesting Ask Me Anything. So I'll take this question right here. We'll put this one up first. So Metal Mark 8 says, what is this channel about? Well, if you're referring to Chris Noggle's YouTube channel, depending on where you're coming in from, obviously our main focus here is on the infinite banking concept and how to take back control of your money and wealth through this unique concept. And this Ask Me Anything is generally for you to ask questions about anything financial related, money related, investing, that kind of stuff. Obviously with the focus on infinite banking, but yeah, it's called Ask Me Anything Happy Hour. So yeah, go ahead and ask us anything you want. Where's the rest of the gang? Yeah, we're a little light today. We got a lot of stuff going on. So I'm not sure where Steven's at. And then someone else is at a baseball game, a bunch of other stuff going on right now. But yeah, so we got the important ones here. Yeah. This isn't being recorded, is it? Yeah. Yeah, we'll dive into the questions here in just a moment. So this one, Eric Berg is asking, how do we get access to the vault recording for the BYOB vault? Do you guys know?
Depends if you're a member or not, right, Brian? If you're a member, you can go.
Well, that was kind of lackluster.
Oh.
That was anticlimactic.
So he froze. So yeah, the
That
vault
was-
obviously is something that you can get involved
You-
with. I think
You
actually,
froze.
right?
Jason, what were you saying?
Go ahead,
What were
Jay.
we
Oh, he's
doing?
back. He's back.
I was just saying, it's inside the vault. There's actually, you can go in there and click. It says something like dig into the vault with Craig and Marius. And you can click in there and you got all the recordings. If you're not a member, you're in luck, because tomorrow at 7 p.m. they're doing another training for those that aren't members yet, right? That's what's happening. So get on that list, show up. The last time they maxed out Zoom and couldn't get more people on there. But if you're a member, it's inside the resources.
So when you log into the vault, just so I'm aware, so you log in and you see there's a thing called instructions. Is that where it's at?
Yes.
Yes. And then if you go down from there, it says cracking into the vault with Craig and Marius, and it says 2 months ago.
Mhm.
Don't let that confuse you. Just click on that and it'll have all the recordings underneath that.
Yep. So there you go. And we got some things that are going to be launched on the vault here coming up in the next, throughout this year, which are pretty exciting. So yeah, just keep an eye out for that. All right, so let's see here. This is kind of a funny one. So Sir Ellis is asking, hey all, is there an Ask Joe Anything happening on Thursdays?
That is true. Tomorrow
What
at
is it?
7 p.m. That'll be the first one.
Nice.
There's an Ask You Anything too?
Yeah.
AGA?
AJ.
AJA?
AJ.
Ask Joe. And
It's called Just Ask Joe.
is that on Chris's channel?
We sent
No.
it's on a Zoom.
Nice.
We sent out invitations, and click on it and join us. So I believe there's already almost 90 people, so there's only room for 10 more.
So, well, you can register. You just can't show up with more than 99.
I don't know how it works. Breezing control, all that.
I've done it before. So typically, you can have as many registrants as you want, but if you have 99 show up, sorry, Mr. 100, you're not getting on. So Joe, if you want to put that into the private chat, I'll put it into the comment box here. If you want to put that in there, I'll share it. Do you have the link?
No.
Come on, let's just call you Bree. Put a wig on.
That's
Now-
why Bree is with
Now,
me.
now do you have the link?
No.
Okay. What's your website actually? What's one?
Realmoneymasters.com. It might be on that.
That's why I asked.
Yes.
All right. So I'll check that out while we're answering some of these questions. Let's get into the first question here. So this is a good one. Savvy Money Strategy H. Hake says, what's the difference in whole life insurance and mutual whole life for BYOB? So let me kind of see what you're asking here. What's the difference in whole life insurance and mutual whole life for, okay, so what they're asking here is you have traditional whole life insurance and then you have whole life that is designed for infinite banking. What's the difference between those two types of policies? So what's one for infinite banking, one for, well, not? Who wants to take that one?
Well, what's Dave Ramsey teach, right? He says, hey, this is the worst place to put your money, right? But as far as we go, we teach something completely different. Whole life, regular whole life, the first few years, there's zero cash value to use. The way that we teach it, we have basically, let's say approximately maybe 70%. So if you use maybe a $10,000 amount just for the first year, let's just give an example for a number. Let's say you had access to $7,000 immediate within 30 days. Some companies are a little bit faster than the 30 days, maybe 7 days. But as far as the typical regular whole life, you don't have access to anything. Might take you 5, 6, 7 years to actually have maybe even 10 or more in that traditional whole life. Hopefully that answers that question.
Yeah, I'll take add a little bit of color to that too. Is well done, Kevin. Like whole life is going to be around 3 years before you start seeing cash value. I mean, Kevin, to have significant amounts, Kevin was right on, but about 3 years. where we're engineering it to add more fuel, if you will, so you can bank with it, so you can have the living benefits in whole life. But they're both good. Like you can use a regular old whole life policy. Like before Nelson Nash, the Rockefellers and some of the other stories you hear, they weren't using specially engineered whole life. They were just using whole life that had cash value because they want that control. They want the guarantees. And a lot of people that have been coming into conversations lately have been just looking for a safer place to park their money. Like with everything going on in the world, they're like, Jason, my money's here. My money's, I had a conversation earlier. Hey, I put 100 grand in a 1% CD. And I was like, okay, well, you can park that somewhere else and have it guaranteed to grow, even if you don't need it, maybe earn dividends and protect your son and family. So what's a better move? Like, so there's a way to store this, whether it's regular whole life, it's probably still a good thing, or it's going to be something designed for a policy like we're doing.
Yeah. And a couple other things to keep in mind there's certain features that we include, the paid up additions and all that for these policies. But the other thing to keep in mind is and this happened one time, and I'll just share this story because a client, I believe this is a client, I can't remember, they hadn't started a policy yet, but they went and how did they do this? So they went on to, I think it was either artificial intelligence or they did a Google search for the top mutual companies in the United States. And it brought up these, 5 companies or 3 companies. And this client did not move forward with a policy because one of the companies that they were with was not one of the top 3. They were one of the top companies, but not the top 3. So anybody want to respond as to why that would occur? Why would you, when you go and Google top mutual insurance companies, one of the ones that we do business with might not be one of the top 3. Why is that? Anybody want to take a guess?
Opinions. Everybody's got an opinion, right?
The top,
factual or not.
Well, no, it's the top 3 mutual. They're huge. These are companies. I think one of them is $500+ billion. They don't do infinite banking.
Yeah.
So this client said, "Hey, I don't want to do this because it's not one of the top ones." I'm like, "Well, those companies are. They're massive. They're almost $1 trillion companies." I said, "You want to work with companies that are very large and do infinite banking." So that's one of the last things I mentioned when it comes to the difference between these ones is there's differences between not just the whole life policy, but the companies themselves. Only certain companies do infinite banking. Some just don't do it. That is what it is. So it's not just the policy itself. It's actually the company, by the way. So Damien,
and to that point, the ones you're talking about, Brian, they're the ones that you see owning stadiums and other things like that, right? So if you had a whole life from them, great company. But if you're trying to do banking and have more control, like Brian just said, then you're going to want to use one of the large mutuals that we work with. And all of them we work with are all profitable, well over 100 years. Every year they've been in business, the youngest one being 121 years old. So
it's like anything else in life or any other product. There's a lot of different companies out there that offer a lot of different products with different requirements. So you need to diligently check all the options and weigh them out. That's why we do the HELOC bingo card. You always got to be looking for what's going to be working in your best interest.
Christian, if you can grab that link. I don't have it. Bree, if you want to grab the link to your Thursday event that Joe's doing, I'll put it in the comment box.
Somebody asked about the link for Just Ask Joe, and I said, I don't have it. Bree has it.
Yeah.
I will get it.
All right, Mr. Skasik. So this is actually, I know this guy. So what's going on, man? He's saying, I was originally planning on doing Roth conversions once I stopped working and hit the appropriate age. Now I'm thinking of taking withdrawals and putting it into another policy. What are your thoughts on that? But whatever you hear, first off, is not financial advice. This is for educational purposes only. We're not financial advisors yet. So kind of know your situation, the Roth conversion. So keep in mind, I'm assuming you're talking about going from some other vehicle to the Roth. It depends on what you're going to do. Are you planning on funding the Roth with additional funds? And then the second question, and we could talk on a call on this, is like, what are you planning on doing with the Roth then? Because on a Roth, you've got to put it to work in order for it to do anything. If it just sits in the Roth, it does zero. It's got to be put to work, whether it's in mutual funds, real estate, or hands-off strategies. Like that's something you got to consider. Into the policy, there's a lot more things happening. So with infinite banking policies, there's layered benefits. Death benefit, which is obviously tax-free, guaranteed generational wealth, the privacy, the protection, the lending ability, guaranteed lending. You don't have to ask permission. Like a Roth, you can only put into certain strategies. They have to qualify. With a policy, you can do whatever you want. It's capped. Do whatever you want with it. So if I was in that situation, which I, by the way, have been in that situation before, why I say this, I wish I had known about infinite banking back then. I didn't. Because if I had known about that back then, I'd still have that money. And I don't have it today. So anybody else want to take a crack at that one?
Yeah, I feel like the way I'm reading it is maybe they have some type of 401k that maybe they're going to convert into a Roth. Depending on age, right? Whether there's some type of penalties, right? Or some kind of fees or taxes, right? That you got to think about and worry about. But as far as converting into a Roth, right? Obviously that's an option. That's something that, many people, it's a strategy, right? But as far as what your current situation is, what your future, planning is, whether it's with your CPA or any other strategist, that's something that you got to kind of take in consideration, and if you're looking at doing a policy that may or may not be beneficial for you.
Yep. And also, by the way, for everybody, I'm going to put in the comment box here in a little bit as well, the link to our Cracking the Vault with Craig and Marius. This is going on tomorrow as well. I thought we had a link to all of our live events, but I don't have it in front of you right now. So if anybody knows what that's at, that'd be awesome.
One thing I want to bring up when doing the Roth conversion, how old are you? That means that you're going to pay taxes right now. And you have to distinguish how much money would you make on that money if you kept it working? How much money would you pay on taxes at that point in time? And how much do you going to give to the government right now? So there's a good what?
He's 49.
So 49. So he still has 10 more years. How long in that 10 years, how much is he going to make if he just kept it there? With that Roth conversion, if he flips it over, he's going to pay the taxes on it now. You're going to pay taxes on it regardless. So you have to calculate it out with the investments that you're going to run it through. And another one is, if you do want to do that Roth conversion before it flips into it, maybe you can run it through the policy and then throw it back into the Roth. I'm not sure about that.
Yeah. And Damien, good question. Yeah, good comment. Yeah, I wish I knew about IBC when I was in the Navy. Absolutely. Brent, good comment here. It says, you're putting your self-directed together with Roth. Best is a self-directed Roth, which, yeah, I've owned self-directed SD IRAs and 401ks both. So, yeah, that's what I was referring to when I said that too as well. It's here.
And there's a lot of companies out there that actually say, like, let's say Schwab, they say, oh, it's a self-directed IRA.
Yeah.
You can't put it into real estate. You can't put it into gold, actual physical, farming or oil or things like that, right? That's a different type of self-directed account, I think, is what Brent Burdick is talking about.
It depends. It depends on who you have the Roth with, because you have custodians, they call that. That's who manages it for you and holds it. You have custodians like you just mentioned, Fidelity, whomever. They're going to have their own product they want you to put your Roth into. Okay, so they're very self-serving, and I've owned those before. But they also, I'm not sure, but they may limit you on what you can do with it. I'm not quite sure. But when I had the self-directed, I had it with a custodian that has no offers. All they do is just hold your IRA for you. That's all. And then they actually have even little things that they would hand out to you to let you know what you can put the Roth into and what you cannot put it into, because there's certain strategies. And so they were really good. So if I was ever to do that again, I would want a custodian that is not, I guess, biased because they have their own product they want you to put your money into, but they will help you put your IRA to work. And that's called the custodian. And we do have some that we actually use and recommend. Let's see here. We're going through that question already there. Okay, so NG is asking here, what is the maximum age to get an IBM policy? I think we just talked about this one here about an hour ago.
We did. My experience has been 75 years old. I've heard some people getting approved maybe with a couple different carriers, a little bit older, but typically around 75 for the majority of the carriers. You can't continue to add PUAs in.
Can you give a couple examples, Jason, maybe to the audience, just to give a little bit more of, hey, the people of that age, what were the premiums? What were they able to do?
Well, I mean, thank you for the additional space, but I would say, like, think of it this way: when you're in your 20s and 30s, you're in the first quarter, or your 30s, you're in the first quarter. Before that, you're not even in the game. Like your son, Kevin, he's not even in the game yet. He's aware there might be a game, but he's not even in a quarter yet. Second quarter is going to be your 40s. Your 50s are going to be halftime. Your 60s, third quarter. Fourth quarter for IBC typically is going to be 70 to 75. I just had a 75-year-old get approved yesterday. It's a normal policy. I mean, he's overfunding it because he's 1035ing, meaning exchanging an IUL, an old IUL that had a fair amount of cash value, like 46 grand. And he was well past 10 years, so no surrender charges. So his policy works really well for him. Like, is that kind of what you meant? Like, he's approved for, I think he's putting in 15,000 a year. He's got 40% going on a base, and he's overfunding it with an exchange, and it worked out really well for him. He got approved, standard, non-tobacco, no rating. And I have a lady in New York with Security Mutual Life, got approved at 75. So if you're healthy and you can be underwritten, you can have a cash value banking system. There's a couple carriers, to be more specific. I think Guardian, you might be able to do paid up additions later than that, right? Because I think Sandra, that was on our team, has done those for folks maybe a couple years older, 76, 77. I'm not sure what the limit is, but 75 has been the best I could do for someone.
Yeah, same here. Now, I'll say this to you. There's a maximum age, but there's also a point at which does it make sense. So it's also kind of the second part to that question as, at what point does it make sense or not make sense? And that's going to be individually, by the way. It's not going to be there's no hard cutoff for that one. But, I've had someone who did one at 74 and it made sense. And I had someone at 72 and it did not make sense. It's just their personal situation and factors came into play. So kind of keep that in mind. But there are some changes to how the policies are structured the older we get as well. And so that's why we do the one-on-one calls, because that'd be a lot to get into here. Okay, so here's a question from Damien. So Damien's asking, question of the day: what is the good and bad between paying monthly versus paying annual on a policy from a growth perspective? Does it have the advantage like an ELF or ETF? Yeah, I mean, we can all talk through the monthly versus annual. I mean, anybody, have experience on that one?
I started my first policy in debt, paycheck to paycheck, on monthly. And as soon as I got out of debt 8 months later, I changed it to semi-annual. And by the 1-year anniversary, I changed it to annual. Because what happens when you put the dollars in for your premium? They're now protected and compounding. Why wouldn't we want to get all the dollars in there at once just to fill the pot and have it all start working right away and take out the maximum amount we need to utilize for whatever we need it for? There's also a little bit more of a cost to the insurance side when you're doing monthly. It's not a huge amount, right? It's just $50 every month, but it adds up. So annual, you're just making a streamlined, more efficient banking system, because it's one time a year you're going in and that to put everything in, and one time a year going in to take it out, unless you're repaying your loans and you don't have a HELOC, and then you're doing your velocity banking or just treating it as your savings account. It's your bank, your pot. But it is definitely better to get all your dollars into the pot where it starts working for you right away, right?
Yeah, I always ask this question when people ask me that question. That was a great explanation, Bree. I always say, do you believe, like I believe, that the wealthy have more choices? Is that fair? So whatever you answer in your head, maybe you don't think that's fair, but if you think that's fair, the way that you structure your premiums is going to have to fit your life. Like if you're an investor and you have like tranches of money coming in different areas, then maybe you want to do a quarterly. Or maybe you want to do it annually, and you can change that mode of payment every year. Like you want that flexibility. But the main reason why you might want to get it in sooner, like maybe you have a lot of money or a significant amount sitting there, and you're planning on going and doing renovations or buying a car or paying off debt all at once, but you want that money to make money for you. Well, then you want to get it in on an annual basis so you can take a loan right in the first 30 days. And then that starts compounding, and you're only paying your employees at the mutual company once a year. If you do it monthly, like Bree started, then you're going to pay them 12 times a year. And that's kind of the difference in cost. It's just how many times is that being serviced on the end of the insurance carrier.
Yep. And the other thing to kind of consider, this is how I've had some people kind of look at it is, your cash flow as a person. Obviously, like Bria, kind of like for you, like as your cash flow allows, you might want to adjust the premium. You can change them, by the way, from monthly to annual, annual to monthly during the life of the policy. And I've had clients do that, by the way. But if you're like a real estate investor and your income is very inconsistent, annual might make a lot of sense. If it's very consistent W-2 income, monthly might make more sense. So it just kind of maps or matches your cash flow is another way to do it.
No, Joe and I, we teach the 4 pillars. Pay yourself first. That's putting it into the policy. Be in control. That's having a policy. Money not in motion does not make money. That's why we keep taking loans and utilizing the policy, and then only spend interest, never principal. So we want all of the money we're going to be spending day to day. We don't want it to just go from income source in our pocket right out into the world where it could potentially be gone forever and not be coming back. We want to run it through the policy, then put it out into the world. So it may have started with taking care of debts, then it turned into expenses, and now we're going into the investment side. And I still want to see that whatever I spent in expenses or living costs for the year is the same amount, if not less, than what I put into my policy, because then I know I actually kept that amount and it's going to be working for me for the rest of my life. Yep. So
if somebody is saving,
it always depends.
If somebody is saving money in a savings account when they have money on monthly and they can go to a quarterly, why would you want to keep your money in the savings account at the bank? The bank keeps their money in insurance. You're keeping your money in the bank. Well, I guess it's time to move up to the next level and go quarterly so that you're warehousing your wealth in your policy, in your bank. So that's kind of the way that I kind of see it.
Yeah, keep it simple, right? Like my last name.
Is that simple?
Yeah.
Awesome.
That's simple.
Hopefully this thing is getting in there. All right. Shirley said, hey, just made my first premium deposit. It's awesome. Will that be available as a loan along with the initial dump I made? Thanks. Yes. So yeah, Shirley, a percentage of your premium deposit will also be available as the cash value, along with a percentage of the dumping as well. So your mentor or implementation agent can help you with those numbers if you have any questions on exactly what they are, but yes. All right. And Savvy Money Strategy has another question here. How long after qualifying for the insurance do I have to sign up with you? I qualified in November, but didn't sign up because I didn't quite understand it.
I don't like hearing that. You shouldn't be applying for anything you don't yet understand. I want you to make sure you understand it, what you're getting, what you're doing, why we're building it the way we're building it before we apply for it. I mean, that's just what makes sense. But I'm glad you waited until you got a better understanding. If you did the insurance or the health exam portion, that's good for 12 months. But if there was any issues or anything that came up or changed since then, we can always check in.
Yeah, you probably just need to start the application process over. They'll, like Bree just said, they'll know whether or not you need a new paramedical or you need one at all, depending on your age. But I'm actually glad you didn't start. I mean, it makes me sad that we weren't able to get to the root of, why you want to start and help you see that you're better off with this and without it. But at the same time, I'm glad you didn't start and give up on it and you're still here. So kudos to you. It's good.
It also depends on what part of it you didn't understand. Because I've had people that they understand infinite banking, but then they get like the life insurance contract and maybe they're a detailed person, and then that opens up a whole other kind of avenue of conversation. So just reach back out and make sure we understand what you got going on, and make sure we solve those problems. Let's see here. So Domin Kalagi 960 here says, I have college loans. Should I open another policy? So awesome, you have one already. So should I open another policy, put a dump in enough to pay the loan? Question, and then take the money out of the policy to pay the college loan. Let me map this. Let me try to understand this here. College loan. Okay, you got that. You have an existing policy. So are you saying open up another one with another dump in to pay the loan, take the money out of the policy to pay the loan? I mean,
it sounds like you're trying to take care of a college loan, but also wanting to protect the money before you pay it.
Yeah, run through the policy makes sense.
yeah, I would max out your first policy, make sure it's efficient. Annual premium, just so you're getting out of the monthly, you get all the dollars in at once, max up the PUA, and then see how much is left over that you still need to fill, and how much you can do. I mean, there's a lot more variables to consider getting another policy than just one loan and having a little bit of money that you want to use.
Sound logic though, right? The logic is, hey, I want my money to make me money before it goes anywhere. And so you're either buying additional PUAs like Bree just said, or you're looking at an additional policy. But we're going to push back a little bit and say, hey, is this floor manageable? Like, can you keep both of these alive?
Yeah,
you know,
when's
what
your
happens?
next anniversary due? Like, are you billing it out throughout the year on a good equilibrium, so you're not back-to-back annual premiums or something for two policies?
So
It's
the thinking
possible they
switch.
might have. I was going to say it's possible maybe they have some type of other policy, right? Like some other term or something of that nature, right? But in this, yes, you use it as a tool. Put the money into work, and then obviously use it for paying off debt, right? That's what we teach. And if you need numbers, go to the vault. It'll teach you all about it, how to get involved and actually see the numbers for you in your situation.
Yeah. But the first question here is the existing policy. Kind of what's going on there first. Because it might already be able to do it. Almost here. Damien, another question here is he was thinking of doing a manual, but I think I want to do annual, but think I want to do monthly on my next to get it automatically out of my account. Yeah, whatever fits, right? All right, so this is the previous question regarding the Roth stuff. Saying I was originally planning on doing Roth conversions once I stopped working and hit the appropriate age, and I'm thinking of taking withdrawals and put it into another policy. Thoughts on that? So what he's talking about here is taking early withdrawal on his Roths or whatever it's in right now before the age of 59 and a half. So it's called an early withdrawal, and there's about a 30% holdback on those in most cases. 20% taxes, 10% penalty from the IRS. Now, some companies don't hold the 20% taxes back, by the way. Some will actually give it to you, and then you have to pay the tax at the end, tax time. But as far as like this is not financial advice or anything like that. But you just have to do the math on it. Does it make sense to leave the money where it's at right now and doing what it's doing, or does it take the hit, goes in the policy, and then it's going to take some time to actually get it to back to break even? But it's just math.
It looks like we missed a question too right before Damian Robinson.
I feel like that one we already did. Was that in Groundhog?
Oh, I did come in late. I might have missed it.
No, not that one. The one we just did. Didn't we just do that one before?
No, it's a separate part to his question.
Okay.
So he had the first one about it, and then this is the follow-up to it. But yeah, knowing your situation, we'd have to probably go into a bit more detail to really understand what makes the most sense and number-wise. Because your policy just went in last year. Yeah, almost a year ago. This is first policy. So, anybody else have any thoughts on that one?
We're still talking about the Roth, right?
Yeah.
My understanding is you could, if it's not, it's just the principle, right? The amount that you put in, it's not the earnings, right? You can't touch the earnings without some type of issue. But if you can actually withdraw the amount that you put in, right, without having any issues, so it's the earnings that they're really worried about, from my understanding. But anything that you put in, you should be able to take right out.
Depending on what kind of Roth.
Yeah, exactly.
Yeah, so most of the time,
just a plain, not work related, just plain Jane on your own.
Yeah. All right. Let's see here. Anthony's got a question here. I do know each situation is different, but for someone age 69, how higher are the required premiums for policies on themselves versus doing one on their child? Is self-policy usually $10K annually for $250K of death benefit is what he's referring to. I mean, the minimum for someone at 69, I would say, is around $700 to $750 per month. The premium.
Now you got to go more than that.
But Jason will do it higher.
You got to go 15 times their age because you're already so close to the fourth quarter. Otherwise, it's not going to function the way that they want for banking. But what they're talking about, like, it doesn't matter. Well, one, it's got to work with that kind of dumping, right? If you're doing 10,000,
that's what I was going to say. The dumping is what matters specifically on that.
Yeah. So I think, Anthony, where you're right and where you're a little off. Again, I talked about the quarters of life, right? You've got your first quarter, second quarter, halftime, third quarter, fourth quarter. I've run illustrations on 21, 31, 41, 51, 61, 71-year-olds, all at $10,000 a year at the same structure. And the cash value is nearly identical, maybe off by a couple $100 in the first year. The big difference is how much is the death benefit, because you have so much more time to work when you're earlier on. And that's the difference, right? So you're not necessarily needing to buy more death benefit. Now, if you're unhealthy and there's other challenges, that could be, but that would be the same no matter what your age was. So if you're healthy and you can get underwritten at 69, it's not more efficient to do it on a child. It's not accurate.
Yeah, a lot of factors in that. And then, of course, not to get into the whole ownership of the policies and all that kind of stuff too.
And the amount they can put into a kid's policy and all those things too. But like, just from an underwriting perspective, if you're the breadwinner, if you're the one providing, protecting your family, if you can get insurance, you want to get insurance. And then you can worry about kids and grandkids policies and those type of things.
Yep. Start at the top. And a good kind of follow-up to this one as far as families go. Do you need a policy for each person, or is there a family policy? It's all individually. So family of 5 policies, family of 3 policies.
There's only one insured on the policy.
Yeah. You can't pick a favorite kid either. You got to insure them all equally. If they're dependents.
18.
If they're dependents.
24 in college?
I don't know. I mean, Diego, we got him as a dependent at 23, right?
I believe it's 24.
Yeah, I thought so too. Good question though.
Have you guys ever done like a second to die, but it's a BYOB policy?
I haven't yet. We learned about it when we went through insurance college, right? Or whatever we did. But no, I haven't. Have you? Has anyone here?
I've inquired from the insurance companies, but they never moved forward with the policy.
Okay.
So I don't really know the ins and outs of it.
But again, in that situation, you're looking for things that aren't necessarily aligned with the strategy of owning the banking function in your life.
Yeah.
Right. So when you get those kind of questions, you understand that someone's thinking about things in a traditional manner, and maybe they're not really thinking about, oh, wait a minute, like I can have this control of this function in my life.
Yep. All right. So just a quick comment by Damien says, I get infinite money coming from the VA, so don't have a problem with that. So yes, that's awesome. By the way, you have a lot of clients that are military, that kind of stuff, and they're taking that money from the VA or whatever they have coming with you that's permanent or going to be there, and they just do that in the policy, and then they have their job, which is their other source of income. Pretty common.
Yeah, I love taking Uncle Sam's money from our VAs. Love working with our veterans and stuff. It's coming in tax free to them. They're putting it in a policy. It's growing tax free, and now they have more control over it, and they can do more things with it. That's a win-win-win. I don't know why the military. I mean, I got this question 4 times. I just made a short on it, but everyone keeps asking me, Jason, why aren't we taught this in school? What do you guys say when someone asks you that question?
Why aren't we?
Yeah, why aren't we taught this in school? Why didn't someone teach us this?
Because they don't want us to know.
Because the people that own 25% of the world's wealth that were doing this themselves created the traditional banking system and the privately owned Federal Reserve to be the middleman and run on a system of debt.
See, Bree, you sound just like I used to sound. You sound like you need a tinfoil hat. And so what I started doing,
Creatures from Jekyll Island, G. Edward Griffin, it's all there, 1913.
No. Hey, you don't have to get defensive. I'm just telling you, sound like I did. So what I started doing, I said, why do you think that? So if you were hearing that question, that's the question I asked you. Why do you think that? Right? Because the common approach is not putting you in control. That's all.
Exactly. And that's how it's a system of debt. One of the first videos we send in our welcome packet after every call Joe and I do with clients is a video by Mike Malone from Gold Silver. And it's a fun little interactive video where he's walking around and you've got illustrations and cartoons playing to show just a visual of how the banking system is designed. And it is a system of debt. When the first dollar being created is being charged at interest to give out, it's a system of debt. You can't knock out one without the other. So it's a mess. And that's a big thing that we cover. We always try to give you guys resources from years over, years, biographies. We're looking at historical accounts of what happened then, like the G. Edward Griffin, Creature from Jekyll Island book, dry reads, short, quick pamphlets, whatever we could get. There's so many ways to get the information. It's just scary once you see it's not what we thought it was going to be, but you can feel it's not what it was going to be because nobody knows. Everyone's hurting. No one wants to talk about money. And there's just a level of confusion and distrust. And that's why Joe and I are so passionate about teach the truth and live the truth and be a product of the product, practice what you preach, test all the waters, be able to point out the bear traps that you stepped in with, while you're hobbling with one leg so the people behind you don't.
I think as a society, traditionally, we always had the family and the parents, right, taught their own kids about money. But now at some point, right, society is definitely needs to change, right? All this debt, all the problems that people have, and no education is happening in schools. Robert Kiyosaki, another gentleman, teaches, financial education, a lot of books, and talks about the same exact thing. Why do we not teach finance information in schools? Some schools do have some type of like business, education, or some type of like smaller scale kind of extracurricular courses. But if schools at least taught something about mortgages or interest rates or something, just to get kids in that mindset of credit cards and student loans, how to buy a house, how to buy a car, at least that would be like a basis of information, versus like, hey, what we do, right? We're on a different scale, different level than most people and what traditionally everybody's doing. And that's why it's just a completely different system. It's a completely different environment of information and knowledge that is just surpassing most people. And if they would just jump on board, learn something new, open their mind, realize what they've been doing is just completely different than what other people are doing, more successful business, multimillionaires, and our other people who maybe created some of these rules, it would be a huge positive for most people. But it just kind of depends on what you're into, who you're watching, who you're following, who you're listening to, and do you believe that change can happen for the better?
Absolutely. We have 1,700 millionaires being created in the US every day, and it is possible. But just like we've seen with the lottery winners, if you don't have the financial literacy to be responsible with your dollars, they dwindle very quickly. And you have to have a system and a strategy. So when you read the history books and you read the biographies of the wealthy and you look at how the banking system was structured and set up and you look at the timeline, these policies have been around since 1845. The modern traditional banking as we know it came out in 1913. The IRA came out in 1974. Very, very new. I mean, there's people alive right now that were around before the IRA was a thing. 1978, 401k came out. Oh. Nobody knows what the creator of the 401k says about it, but he calls it a monster. In the book, the 501k plan. And that's where Ted Benna, the creator of the 401k, puts all his retirement money. Well, what's the 501k plan? Why doesn't anyone know about it? The creator of the 401k is telling us to use a 501k, but only everyone in society knows about 401k. This is the 501k plan. These systems and strategies are being used by Robert Kiyosaki. They're used by the Rockefellers and the Rothschilds. We don't want to go the way of the Vanderbilts. So we look to the Rothschilds and the Rockefellers. What did they do differently? They had family constitution. They had family trust. They had family office. They had structure. They had systems and processes, and they ensured the knowledge carried on to each generation preceding and coming later. So that's what we do. We're going to get it out there. We're going to shake up the system.
Amen.
We'll wrap up some of these questions here. So Brent, kind of quick comment / question. You can't move the Roth to a policy without an exchange. There is no exchange, correct? So you cannot do any kind of exchange across from one to the other. It has to be a permanent withdrawal from the Roth, which is a qualified retirement account, and then it goes into a policy. If you want to do that and it makes sense. let's see here. So I think this is a follow-up question to one of the ones we mentioned or answered prior. So my first policy I started when I was in school. I'm only putting in $500 annually, but now I have a job and I have enough to pay off my loans now, but should do that or open up another and then pay myself back. So a question on this one is, when you said you have enough to pay your loans back, is that inside the existing policy?
That's the student loans that he was talking about before.
Right.
And I would be looking at your income. He
has a policy already. He has a first policy.
Yes. Yeah.
So
and if we're
how much you have inside
putting in
that.
$500 annually, we would see how much we've got in PUA. I don't think we'd be able to fit whatever we have enough to pay back college loans.
Yeah. So I was going to say on this one, there's a lot of unknowns here.
Yeah.
Yeah, we've got quite a few. So I would just recommend schedule a call with one of our mentors, or if you have one already, just hop on a quick call with them and walk through it, and you can see what the best use is for those funds, whether it's a new policy or the existing one. Yeah. But awesome. We started a policy in school, man. It's awesome.
Yeah, that is super cool. And maybe he's got a lot of more room that he didn't even know about, right?
Maybe.
That built it.
Yeah. I've had some people in school that they got approved for like a $500, $600 premium, but they didn't put that full amount in at the very beginning. They wanted to get approved now, but then they started putting the full amount when they graduated. So yeah, so then maybe they're doing that. Let's see here from J10. So need to save for down payment. Want to place in policy, however, can't take a loan out since the bank will need to see funds available. Suggestions.
It only takes a couple of weeks to run money through a policy back into the bank account. And my bank was really understanding, both banks actually, from when we got the house and when we got my car last year. They were understanding that we do private banking and our money is in different places that are not quite traditional, but we have the funds and we can get them the funds. So
why are you saying, J10, why are you saying here that you can't take a loan out since the bank will need to see the funds available? I'm not quite
sure. For the down payment for the house.
They talk about a house.
Yeah, but banks still recognize these policies as assets. So if you show them you have the cash value in the policy, they're going to acknowledge it as part of your proof of funds.
It's a liquid asset. Yeah.
Yep.
So, yeah, Jay, we can always run through it if you want on a one-on-one call too.
Usually on the loan form, it's cash is first, and cash policy, cash value is usually 2 or 3.
Yep.
I've got people ask the balance sheet or income statement, right? I think you're talking about, Joe.
When they're doing a loan, when you're filling out a loan for a bank, for a mortgage, or it'll say cash on hand, and usually number 2 line or 3 line is cash value from a life insurance policy.
Yeah. I did that one time. This is years and years ago, and it was for some sort of financial guy. He didn't know what that meant. This was the financial advisor, by the way, and he didn't know what that meant. And kind of blew me away.
Well, Ariana's teacher said, "Oh, don't worry about that. Nobody does that." So that was in school.
Well, her teacher also thinks a house is an asset.
That's true. That's true.
Yeah. Oh my gosh. Yep. All that cash flow coming from it right now. All right. So David, this is a quick comment he says here is just to all my disabled vets, get a policy, get a credit card, live off the card, send cash to the policy, take a loan, pay the card. So he's just obviously a proponent of infinite banking. That's not financial advice, by the way. So keep that in mind.
I love you, Damien. Thank you for telling it like it is.
Anthony, I think this refers back to the IRA thing again. So when you pull an IRA out, you have to pay taxes, 20%. They hold back the 10% penalty. He's saying here, a less withholding of taxes allows for velocity banking. Yeah, so if you don't have to pay taxes on something like that, what people will do is they won't pay the taxes on the withdrawal of the 401k or IRA. They'll put it to work in something and then use that loan to then pay the taxes down the road and then pay themselves back instead of giving that free money to the IRS. So,
or you can come to Alaska. We don't have income tax or state tax.
There we go. Bears. The Bears. Here.
If only all the states were like that.
Yeah.
Power to the people. We'll bring it back.
My parents are Alaska residents, but not me.
Yeah, Jay's in Florida, right? Didn't they just approve, or they're talking about approving property taxes, getting rid of those or something?
Yeah, we'll see. We'll see on that one. I'm not a betting guy on that one. But yeah, so this is I think this is a follow-up to his question. If you're using the policy already and have outstanding loans, then there is no funds in the policy to use for the actual down payment.
If you have income coming in, you can also be repaying those loans. If you prioritize running as much of your income into your policy to offset and pay back loans, or ideally it's premium, PUA, loan repayment. And if you're trying to run as much of your income into your policy as possible, any loans you're paying off quicker than their annual interest expected date, which is your anniversary of the policy, and then you're offsetting your interest. So I was paying 1 to 3% for my loans from Velocity Banking. If you don't have the down payment because you have the outstanding loans, then you don't have the money. But if you have the money, just pay back your loans and the money's right there ready to go again.
So this was the first question he asked, was need to save for down payment, want to place in policy. So
saving for a down payment.
So yeah, if you're saving for the down payment, you save it into the policy loan because it's still liquid, but you're paying less interest, but you're building up your reserves for that down payment. But yeah, and as far as the banks seeing the funds, if it's inside the policy, it's a liquid asset. I mean, there you go. And as I think Bree mentioned, you can just borrow the money back right out really quick if you want and put it right back in. I mean, yeah. So banks will actually see that and know what it is. Getting into the good questions. So yeah, this is what you guys are talking about. Yeah, almost everybody ever explained this BYOB to thinks their house is an asset. I used to think so a few years back as well. So I know. Joe, you want to elaborate on that a little bit? What they mean?
So everybody thinks their house is an asset, but what is an asset? An asset is a cash producing entity. Your house does not produce or give you money per month. So in answer to that question before, I said, well, Ariana, did you raise your hand and ask the teacher, how much does your house give you per month? The way that your house can be an asset is by going in and grabbing the equity out of the 2x4s, getting a HELOC from the bank, actually taking that money, putting it to use to bring you arbitrage, putting into an opportunity and making you money. So that is the way to make your house an asset. Or if you lived in a duplex, you lived on one side and the other side was rented out, that would be an asset.
Yep.
Asset gives you money in your pocket. Liabilities take money. Right? Common, basic. Yeah. There's simple stuff. However, I do know there's a myth out there. They talk about this is why they think of that, right? Like if you buy a car, oh, I have an asset, right? Like, hey, if I sell this, I can get some type of value. But really, it's an asset to the bank because you have some type of loan and you're paying them, right? So they're collecting on that. But God forbid something happens, if you got to sell your house, yes, there's some type of value there that you'd give. So yes, there's two different ways to kind of look at it from a asset point, and asset goes into your pocket. That's the biggest one. That's the biggest mindset change that Robbie Kiyosaki, cash flow game, cash flow for kid game. If you're got kids, go buy that game, play it with them. It's super fun. And that'll teach your kids at a young age all about assets and liabilities.
For everybody out there who thinks a car is an asset, on Monday, I want you to go to buy a brand new car, pull it off the lot, and sell it on Friday. How much money did you make?
Hey, Joe, it is an asset, though. Not for you.
We just had a client that called twice today, just to show you guys the understanding of HELOC versus mortgage. And he was reaching out to his bank. They said 95% LTV for his home. Gave him all the answers for his little check sheet. Then they ran his credit. Then they saw the house value. And then they started calling. He was getting higher ups from the bank calling him, being like, are you sure you want to make this move? Because your payment's going to be double. The interest rate is so much more. He's like, yep, I'm sure. I'm 100%. And then he called back again an hour later saying 2 more people called me from the bank. They're asking, am I really sure that I want to go to a HELOC and not just take 500 to get out? And I have the mortgage with them. And I told them, if you said this is the way it's going to be. So either you're giving me amazing customer service now because you don't understand it and think I'm making a mistake, or you understand it and you don't want to miss out on the $700,000 to amortize the loan for the next 30 years.
Yeah.
So
he was going from a 6% mortgage to a 8% HELOC or something like that.
7-something%.
7-something. So he's going to be saving at least 6.15, almost half. So his 6% amortized loan is going to be around 14 to 15%, and he's going to 7, so he's going to be saving half. Smart move.
Never had someone higher up in the bank call though to say, are you sure you want to make this decision? Like, don't take our money away.
Yeah.
Oh, that I had a banker on the other day tell me that and he's pretty high up in the bank, does technology stuff for the banks, writing a book on all this stuff, and said, Jason, I don't feel real comfortable what we're going to see in the next couple of months. It's going to look a little bit like 2008. We're going to see a lot of banks failing. So that would show why that action was happening. If you kind of think like when anybody's telling you something, you have to understand it. Don't listen to what they're saying. Try to understand why they're telling you that. Like that's the message. The message is loud and clear. Banks don't want to lose your business to something like that.
One man's asset is another man's liability. Look for them.
That's what I was saying to Kevin earlier. Like, man, these car loans are great for banks. What an asset. Especially the higher your credit is, good job. You know what that means? The more likely you pay on time, the more they're going to give you loans, and the more ability they're going to let you use their money to pay them interest.
Real estate investors see properties as assets, dwellings, buildings as assets. And then for the banks, it's the note, right? And private money lenders, it's the note. Who's paying me?
All right,
we make it through all the questions?
Yeah, one last one. We'll do this one quick. So Dex, good question here. So Dexter's asking this. So you're saying always pay premium
Who
first.
said that?
Yeah. Max PUA, then pay back loans as you go. Sounds
Premium
like a good
keeps
idea.
policy alive.
Gold star.
PUA puts in cash value, and loan repayment, when all the others are filled, allows you to offset what you're paying in interest and reuse the funds again.
Yeah, I'm going to say, Dex, it depends, man. I don't know if that's always the right move. It depends on kind of what else is going on. But I mean, if you're looking to expand your system, yeah, that makes sense. If you want your money to work for you before you use it, yeah, that makes sense. But, you know, there might be a scenario where refilling the bucket of the loan makes more sense, depending on what else is going on in your life.
Once you put it in PUA, aren't you able to borrow it back out, and doesn't it fill it back up?
Depends. I mean, you can, but you still borrow out. You get roughly 94 cents of every dollar of the PUA you put in. So you're already a little less liquid. And I mean, you know, it's growing for you, and you can borrow up to 90% of that. So you can actually borrow out like 81%.
Premium and PUA fill the bucket. Loan repayment makes the bucket available to utilize again. So I'm always in the interest of getting the growth on all the dollars I can. And I still know there's going to be money running over here that's not going into the policies. So that's why I went maximum efficiency. But
Yep.
everyone's different. It really is a case by case. Sometimes I do one thing with my policy 1 month and something completely different another month or another year. It's about you getting the understanding of the formulas. You need to know the variables that you need to look at depending on what problem you're trying to solve for. Which one?
Anthony, the short answer is yes.
Because more money just compounding right away versus having to, 100 here, 100 this month, 100 this month, whatever the premium is. Getting it all in at once means now you have X amount working for you for dividends or earning interest and dividends versus waiting for little bit by little bit by little bit.
Yep.
Cool. Well, we made it through all the questions.
Did we hit that IUL one? Because again, I came in late. There was one that was asking about right at 59 after. So just before 5 o'clock.
Yeah, I don't think we hit on this one just because the whole IUL thing was just beaten to death. So, I mean, so many videos on this one.
I was just surprised to see it. If he has one that works that well, I'd love to see it.
I'd love to see that. Yeah, show us the policy that's been in place for at least a minimum of about 7 years. That does that, 10 years preferably, and we'll talk. But yeah, so
most
yeah,
IULs have a 0% floor.
Yeah,
so.
I'm yet to see an IUL that actually functions better than what we built for
One truly compounds, the other goes up, down, and then increasing premiums and.
Yeah.
Go on Chris's channel and Google that right on his channel. Yeah. You'll find tons of videos.
Go to Google and go IUL space L and then see what Google pre-populates for the rest.
Just look up Kyle Busch. How many millions did he lose?
That would come up when they search IUL L. Oh. It'll pre-populate the rest of the word.
Well, we made it through it.
All right, guys.
Another Ask Me Anything. All right. So with that, we do have I forgot to put the 3-day event link in here, but we do have a 3-day event coming up here. Go ahead and check out chrisnoggle.com for that link. That's going to be an awesome event we're going to be doing here. So check that one out. But with that, thanks everybody for the questions, and we will see you next week.
Bye.